Welcome to the research desk.
Glad to be here for this one.
Yeah, today's deep dive into the source material explores a fundamental reality that, frankly, you just have to face right now. We are looking at the epistemic crisis of value.
And we need to be perfectly clear right out of the gate on this.
Absolutely. No hedging today. The traditional investment models you have relied on for the last 2 decades, they are dead.
Completely dead.
Risk in a multipolar, highly volatile world is being completely redefined. The old playbooks are not just underperforming, they are actively destroying capital.
Actively destroying it, yes.
So we are going to strip down the data to show you exactly how these geopolitical tectonic plates are shifting, how economic interdependence is being weaponized, and really the exact steps you must take to survive this new financial reality.
Right.
But let's unpack this first. We use this term epistemic crisis. What does that actually mean for the person listening to this right now?
It means we have a crisis in how we actually know what we know. The shift is absolute. Market narratives now ruthlessly prioritize intangible assets and future optionality over present cash flows. For decades, investors operated under this really comfortable assumption that intrinsic value was a static, discoverable number.
You run the math, you find the number.
Make the trade, exactly. But that is no longer true. We aren't just witnessing the obsolescence of traditional financial formulas, we are witnessing a profound redefinition of value itself.
The ground has fundamentally moved.
It has. And those who are still using the old maps are walking directly off a cliff.
Okay, let's look at the core of this failure because it starts with the foundational grammar of finance, right? The discounted cash flow model, or DCF.
Yes, the DCF trap.
If you have ever taken a finance class or read an analyst report, you know DCF. It remains the indispensable language of financial analysis. The entire market speaks it.
The basic idea is you project how much cash a company will make in the future.
And you discount it back to what that money is worth today.
Exactly. But the inputs being plugged into these models right now are deeply, fatally flawed.
Fatal is the right word. We are seeing analysts treat highly speculative assumptions as mathematical certainties.
And the danger here is entirely quantifiable. It is catastrophic. The math dictates that the terminal value, which is the assumption of a company's worth into perpetuity, essentially forever.
Right. The terminal value carries the vast majority of the weight in a DCF model.
It does all the heavy lifting. And here is the hard reality. A mere 1 to 2% overestimation in long-term growth rates artificially inflates DCF valuations by a staggering 20 to 50%.
Wow. Wait, let me repeat that because it is the most important math you will hear today.
Please do.
A 2% input error equals a 50% valuation error.
It is wild, isn't it?
Just to visualize that for you listening, imagine you are buying a business and you assume it will grow at 4% a year instead of 2%.
Right.
That tiny little tweak on a spreadsheet means you might end up paying 50% more for that business today. You are paying a massive premium based on a complete guess.
Precisely. Terminal values across the market are currently being pumped up by unproven best-case scenarios. And what are these models ignoring?
Reality.
They're ignoring reality. Systemic geopolitical risks and the weaponization of critical supply chains remain woefully undermodeled. The current financial models are projecting infinite peace and infinite growth in a world that guarantees neither.
Which brings us to a really fascinating data point in the research regarding universal factor models. Now, before we get into the numbers, let's quickly define what a factor model actually is.
Sure.
Simply put, it is a quantitative strategy where you group stocks based on specific traits, like value stocks that look cheap or momentum stocks that are going up.
And the idea has always been that you can apply a one-size-fits-all factor model anywhere in the world.
Right, but that is categorically false. These universal models fail spectacularly when tested against diverse global realities.
The failure is absolute. Look at the U.S. value premium, which is the excess return you get from buying cheap value stocks over expensive growth stocks.
Right.
It yielded a negative 2.1% average annual return from 2018 to 2023. It lost money.
Okay.
But if you deployed that exact same value factor formula in China A shares during the identical time period, you saw a positive 4.3% return.
So wait, just so we are totally clear on this, you use the exact same mathematical formula, the exact same universal theory of value, over the exact same 5-year period.
Yes.
In the US, you lose 2% a year. In China, you make over 4% a year.
Exactly.
That is a massive divergence.
It is a massive divergence driven entirely by regional market structures.
Yep.
State intervention, corporate governance norms, retail investor behavior, these are completely different ecosystems.
Right.
To understand why universal models fail, we must look at a brilliant culinary analogy from the source material.
Woke.
Oh, I love this concept. Woke translates to the breath of the woke, right?
Yes, in traditional Asian cooking, woke is that complex, smoky flavor you can only achieve if the chef perfectly masters the intense heat of the wok, the precise timing of the toss, and the specific spices required for a regional palate. Right, you can't just fake it.
No, you cannot achieve woke by dropping a generic, standardized recipe into a different kitchen. Quantitative financial models are exactly the same.
They have to be adapted.
They must be fiercely calibrated to local regional market structures to survive. You cannot cook a localized market with a globalized recipe.
That is such a great way to put it.
A factor model built on the assumptions of 20th century American corporate governance will just burn to the ground in an entirely different geopolitical environment.
So if traditional universal models are failing and regional calibration is mandatory, what is actually driving the immense valuations we are seeing in the market today?
That is the trillion-dollar question.
Because if it is not fundamental math, what is it? And here is where it gets really interesting. This introduces the ascendance of narrative capital.
Yes. Narrative capital.
Narrative capital is the immense optionality, the collective effervescence, and the shared stories that are driving growth stock valuations. These are massive forces that traditional accounting completely ignores.
Completely ignores.
When a company establishes a dominant narrative, network effects take over. It creates a winner-takes-all psychology.
And this is not just a theory. It is a structural reality. The belief in a company's future narrative actually lowers its real-world cost of capital.
Because everyone believes the story.
Exactly. Because everyone believes it, the company can borrow money cheaper and issue stock at higher prices, allowing it to fund the very growth it promised.
It is a literal self-fulfilling prophecy.
We are looking at an unquantifiable trillion-dollar force. Trillions of dollars are currently being directed by sociological forces, collective belief, momentum, shared identity that we can describe qualitatively but cannot yet precisely model quantitatively.
Right, we don't have the math for it.
We don't. Without a robust methodology to measure this narrative force, market participants are flying blind. They're using standard accounting to measure a psychological phenomena.
But as we know, gravity always exerts its pull. You can only stretch a rubber band so far before it snaps.
And a snap.
That is the fundamental reality check we are facing. There is an extreme, highly dangerous tension right now between narrative capital and fundamental valuation.
The reality check is stark. Look at the data from the fourth quarter of 2023. The median price-to-sales ratio for the top 20 NASDAQ Q100 growth stocks hit an astonishing 12.5 times.
Let me jump in to translate that for you listening. A price-to-sales ratio, or PS ratio, compares a company's stock price to its revenues. It tells you how much the market is willing to pay for every single dollar of sales the company actually brings in the door.
Right.
So paying 12.5 times means investors are paying $12.50 for every $1 of sales.
Correct. And to put that 12.5 times multiple into perspective, the historical average is 3.8 times.
Wow. So they are paying...
The market is paying more than triple the historical premium for every dollar of sales.
That is insane.
This is a massive distortion driven almost entirely by narrative force rather than fundamental cash flow generation.
And we have a very clear historical precedent for this. It is a direct parallel.
The dot-com bubble.
The late 1990s dot-com bubble was driven by the exact same speculative misapplication of DCF inputs. Analysts back then were justifying astronomical valuations by projecting impossible growth rates into perpetuity.
They threw out traditional metrics and started valuing companies based on
eyeballs and clicks.
Exactly. Eyeballs.
It was fueled entirely by the narrative of the new internet economy. And what happened? When the tension between the narrative and reality finally snapped, the NASDAQ lost 78% of its value.
78% gone.
The mechanics of that late 90s crash are identical to the mispricing we see in today's most narrative-driven growth stocks.
The mechanics are absolutely identical. And this intense tension between narrative and reality is perfectly encapsulated in the digital scarcity paradox of Bitcoin.
Oh, this is a great example.
The narrative trajectory of Bitcoin mirrors the classic hero's journey. It transformed from an anti-establishment outsider, cypherpunk rebellion against fiat currency, into a mainstream institutionalized asset.
Right.
This narrative is incredibly powerful.
It is a phenomenal story. And it is fueled by very real structural events. You have the approval of spot ETFs, which suddenly opened the floodgates for traditional investors to buy in without needing a digital wallet.
Yeah.
You have the programmatic halving events, which literally cut the supply of new coins in half every 4 years, reinforcing its structural scarcity.
And in politically unstable economies, it actively serves as a critical store of value. The narrative has successfully labeled Bitcoin as digital gold.
Digital gold. Everyone says it.
But the financialization reality completely dismantles that digital gold thesis.
Completely.
When you look at the hard data, the narrative falls apart. Look at the first quarter of 2022. During that period, Bitcoin's 60-day correlation with the Nasdaq Q100 reached 0.68.
And correlation just means how closely two things move together. A correlation of 1.0 means they move in perfect lockstep. So 0.68 is incredibly high.
Very high.
It means Bitcoin was trading exactly like speculative tech stocks.
Exactly. It was moving in lockstep with the Nasdaq. But meanwhile, its correlation with physical gold remained completely flat, sitting below 0.1.
It had practically zero relationship with actual gold.
Zero. Furthermore, you must look at the volatility profile. An asset cannot function as a stable store of value for institutional portfolios when its annualized volatility exceeds 70%.
70%.
Yes. Physical gold rarely tops 20% annualized volatility.
So we have this term in finance called high beta, which basically means an asset is a roller coaster. It swings wildly with the market. If the market goes up, it rockets up. If the market goes down, it crashes.
And that is exactly what Bitcoin is. The data brutally demonstrates that Bitcoin is not behaving as a safe haven. It is not digital gold. It is behaving as a highly financialized, high-beta, leveraged technology play.
The narrative says one thing, but the market structure dictates another.
Precisely.
And this disconnect between narrative and structural reality doesn't just apply to crypto or growth stocks. It extends to the very foundation of the modern economy.
Yes, the physical infrastructure.
Right now, the market is entirely focused on the software and the narrative of the AI gold rush. Everyone is obsessed with the latest language model.
But the market is fundamentally underpricing the critical physical infrastructure, making that AI actually possible.
Data centers, fiber optics, specialized power infrastructure, these are the essential bedrock of the AI revolution. And more importantly, this infrastructure is bound to physical geography and geopolitics.
And geopolitics is the variable the models ignore. Take rare earth elements, for example.
Okay.
They possess immense, underappreciated geopolitical leverage. You need them for advanced technology, for defense, for AI infrastructure.
You can't build any of it without them.
No, you can't. In a multipolar world, investments in non-Chinese rare earth miners are not just basic commodities plays. They represent compelling strategic bets on national security.
Which brings us to a stark historical warning. We keep talking about how dangerous it is to rely on old models in a new world. We have to talk about the collapse of long-term capital management, or LTCM.
Yes. LTCM is the ultimate warning regarding the fragility of models. This was a hedge fund in the late 1990s run by literal Nobel laureates.
The smartest guys in the room.
They had the smartest guys in the room, built on the most sophisticated financial models in existence. But those models were built purely on historical data. They assumed the future would look exactly like the past.
And then 1998 happened.
Russia defaulted on its sovereign debt. This was a novel geopolitical shock that their historical data sets deemed practically impossible.
It wasn't in the data, so the model said it couldn't happen.
Exactly. The models did not account for it. As a result, the models failed catastrophically. The fund imploded, and it nearly took the entire global financial system down with it.
Just incredible.
The lesson here is absolute. Models built solely on historical data are fragile. They cannot predict novel geopolitical shocks.
Relying on backward-looking data in our current era of weaponized supply chains and shifting global alliances is not just foolish, it is actively dangerous.
Very dangerous.
So what does this all mean for you? If you are managing your own money or leading a business, how do you navigate this? Because the crisis we are documenting today is not just financial, it is epistemological. The very way we know what we know about value is broken.
You must understand that intrinsic value is not a fixed Platonic number waiting to be discovered on a spreadsheet.
Right.
It is a negotiated, shared linguistic agreement among market participants. DCF remains an essential grammar, yes. but the vocabulary of value has permanently expanded.
The vocabulary has expanded.
Yes. To survive this paradigm, your valuation methodology must shift from seeking a single intrinsic number to building probability-weighted distributions that actively account for extreme structural changes. You have to map out multiple futures, not just one.
Based on this rigorous analysis of the source material, here are the authoritative portfolio actions you must take to survive this new paradigm. We are going to break this down step by step. First, you must layer your DCF models with aggressive scenario analysis and a strict geopolitical risk overlay. You must actively integrate the value of optionality into your models. You cannot assume a straight line of growth anymore.
Second, meticulously track the divergence between market narratives and actual fundamental earnings.
Yes.
When you see a price-to-sales ratio hit 12.5 times against a historical average of 3.8 times, that divergence is a siren. It is flashing red. You must respect the tension between the story and the cash flow.
Third, regarding Bitcoin, treat it strictly as a barbell strategy. Let's define a barbell strategy quickly.
Sure.
Imagine a weightlifter's barbell. You have heavy weights on both extreme ends and nothing in the middle. In your portfolio, it means you pair extreme safety with a tiny amount of extreme risk.
Right.
So maintain a 2 to 5% speculative allocation in Bitcoin to capture that massive narrative upside, but balance it against a 10 to 15% allocation in physical gold for actual structural stability.
Fourth, regionalize your factor models immediately. Remember the woke analogy.
The breath of the woke.
You cannot take a U.S. strategy and blindly apply it to emerging markets. The recipes do not transfer. And finally, invest heavily in your own geopolitical literacy and allocate capital to the critical physical infrastructure underlying AI.
Do not just buy the software. Buy the power grid, the data centers, and the rare earth elements that make the software run.
The stakes here could not be higher. We are operating in a completely new environment.
We really are.
The ultimate takeaway from navigating this epistemic crisis is understanding the nature of certainty itself.
Yeah.
The most dangerous illusion in the market today is not the idea that intrinsic value does not exist. The most dangerous illusion is the arrogant certainty that we already know how to find it.
That is perfectly stated. I will leave you with a final provocative thought to mull over. If value is indeed a negotiated linguistic agreement, if it is a shared story, look closely at your own industry, your own business, or your own career right now.
What a great question.
What specific narrative capital are you blindly treating as a fundamental law of physics? And what happens to your personal portfolio skills when that shared story suddenly changes? This is the research desk officially signing off.